Hi, folks. In the last few months, I've received a few queries about covering breaks in income through withdrawal of funds from mutual funds. The break could have been due to either a job cut or sabbatical, or to cover some excess expenditure which is occurring in the next few months, or even planning for retirement. So, systematic withdrawal plan forms a tool whereby you can withdraw money systematically from your mutual funds instead of taking out money, the whole corpus, or even large chunks of the corpus at one point of time. You can use it as a steady flow of money into your account. Now, there are a lot of information about this topic and you'll find it easily available. However, I just thought I'd work the data and to understand it better and also present it in a slightly non-technical way, which can be easy to understand. As I mentioned earlier, the systematic withdrawal plan is a tool which the mutual fund allows you to withdraw money at systematic intervals. Usually people use it on a monthly basis, but it can be done on a weekly or a daily basis also, and even quarterly or annually depending on the fund. So you can set a date on which you require the money and a time period, and the money will get credited into your account from your mutual fund investment, provided you have money in that folio. Now, the assumptions I've made for this study is that an investor is going to invest a lump sum amount of 6 lakh rupees. They're going to withdraw at the rate of 6,000 rupees per month, which is 1% per month or adding up to 12% a year. Also, the investor is okay to leave the money untouched for the first 12 months and only start withdrawing after 12 months so that they can take benefit of the long term capital gains taxation which is available in India for mutual funds. The methodology I've used here is that I've chosen the HDFC Balanced Advantage Fund growth option. This is simply because data is available from 2006. I have plotted the data for the beginning of every month, and then I've assumed that the withdrawal will happen from the 13th month onwards. In this snapshot, I've given the initial part of the data where you can see that the NAV date is 3rd April and the investor invests 6 lakhs rupees at the NAV value of 42.329 rupees. Therefore, they get the allocation of 14,174.68 units. Now, these units are held for a 12-month period and the investor starts withdrawing the money from April 2007 onwards. So, the 6,000 rupees has been withdrawn. So, on 2nd April 2007, you can see that the NAV has gone up marginally to 43.18. Therefore, the fund value has moved up to 6,21,000. The investor does a withdrawal of 6,000 rupees, or actually, the withdrawal is units of 136.94. The closing balance of units drops down to 14,038 units, and the closing fund value 6,15,064. Now, on May 3rd, the value of the fund based on the closing or available number of units becomes 6,90,000 because there's a significant jump in NAV between the 2 months. And again, the investor has withdrawn 6,000 rupees or 122.05 units, and therefore the closing fund value 6.84 lakhs. So on and so forth. The withdrawal has been done till 1st Jan 2025. So, what has been the effect of the market on the 6 lakh rupees that this investor has invested? To understand this effect, I have plotted this data whereby I have plotted that the investment month will be always April. So, the investor would start either on April 2006 or April 2007, so on and so forth. And they would also start the withdrawal 1 year later. That is, if I've invested in on April 2006, I would start my withdrawals from April 2007. If I've started my investment in April 2007, I would hold on for a year and withdraw from April 2008 onwards. So, what is the fund value on 1st Jan 2025 if I had followed this, or for any of this scenario, whenever I had started my withdrawal, what would be the fund value at the end of it? So you can see that only in two cases, that is, if I had started investment in April 2008 and April 2011, then the fund value would have been lesser than my original investment of 6 lakh rupees. In all other cases, I'm crossing 6 lakh rupee fund value. Also, there is, in some cases, a significant increase in my fund value despite withdrawing steadily 6,000 rupees every month. So, if I had invested from April 2009, I would have reached almost close to 40 lakhs. If I had invested in April 2020, even my value would have climbed to 16 lakh 45,000 as of now. And in some other cases, it's 13 lakhs. In a few cases, it is close to the original 6 lakhs as well. Again, to understand the effect of the starting NAV and the NAV from which I started withdrawal, I plotted that as well. So in two cases, you can see that my fund value is less than 6 lakhs. What was the NAV when I started? On one, it was 62 rupees. And when I started withdrawing, it was 39 rupees. So it was a drop of 37%. But in the second case, my NAV dropped only by 3% after investing and then when I started. In two other cases, also, there was a negative NAV or a negative movement of the NAV. One was minus 6% and minus 28%. But in both cases, by now, I would have been at a profit over my initial investment of 6 lakh rupees. So, to summarize, in 18 scenarios, only two times the fund value has dropped below the value originally invested. However, when I look at the starting NAV and the NAV which I withdrawn, I'm not able to draw any conclusion. Yes, even when I started and there's a high fund value at the end of it, was there a significant jump in NAV when I started? Yes, it is there, but this is not conclusive. This data set itself is very small. Ideally, these kind of scenarios should be plotted on various funds across categories on large data sets. I've just done a little to understand this better. Now, you could very well say that I have taken a time when markets have moved from lows to all time highs, and that could be having a positive effect on this, which is probably right. And when would we have needed this fund from 2006 onwards? Probably 6 months after COVID. Many people face job loss, many people have faced job cut, so they may have required this amount. So what would have happened in that case? Let's say that in October 2020, what if I had to withdraw the money, where would I stand at? If we look at the chart again, we can see that out of 14 instances, 9 times the fund value had returned less than 6 lakh rupees. So if I had have withdrawn the money after 6 months of COVID because I had lost my job or I had a huge expense due to medical or some other issue, then I would have actually been withdrawing at a loss to my original investment. Of course, this is without factoring in the amount of withdrawals I would have done. So, the way to look at this is that equity funds and even hybrid funds, such as HDFC Balance Advantage funds, are volatile and can have long periods of underperformance. This could in turn get affected because you're constantly withdrawing money from the fund. So, it could lead to even further performance being poor. Therefore, experts often suggest that it is better to use debt funds. Now, somebody could argue that what if I increase my initial investment and reduce my rate of withdrawal? Yes, definitely that would help. In this earlier scenario, if I had invested 12 lakhs and I was taking out 6,000 rupees, which is 0.5% withdrawal per month, it would definitely impact the portfolio much lesser and therefore my fund value would be higher. But we cannot fully depend on equity funds because they are prone to some amount of underperformance. A long period of underperformance can hurt our returns. That is why experts suggest debt funds. So probably what you could do is that when you require the amount, you could withdraw a chunk of it, place it into a debt fund, and then set up a systematic withdrawal from there. So, for example, if you're a retired person, you know that your expenditure per month is going to be 1 lakh rupees. When markets are favorable, you can take out that one. You can take out 1 lakh into 36. That is the expenditure for the next 3 years and place it into a debt fund. Debt funds at this time are expected to give somewhere between 5 to 7% annualized return. From here, you can start withdrawing 1 lakh rupees at a monthly interval. When these funds are close to being depleted, and if your markets are supporting your equity funds, then you can take out another chunk out of it and place it back into this debt fund and continue your systematic withdrawal plan. So, I hope this information helps you to better understand how systematic withdrawal plans can help you. They are a useful tool, but they also require planning like any other financial tool or instrument. If you have any queries, please do drop a comment or write into us and we'll be happy to get back to you. Thanks for watching.